Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for July 5th, 2013. This week's topic, the footprints of hot stocks. We'll get right into that. A hot stock is one that makes a market-beating trend over a number of hours, days, weeks, or months. What is key is that we see gains day after day, or minute after minute, or week after week, whatever particular time frame you are trading. What we don't consider a hot stock is those that gap up on big news and go from one price to another overnight. And the reason we don't consider those hot stocks is because it's not something we can really take advantage of unless we get lucky and own that stock the day before it makes the big gap. We don't really participate in the big gain. Now, what I have found is that the great majority of hot stocks start their market-beating move with abnormal price and volume activity. And so I call the footprints of hot stocks action candles. Now, I have programmed a formula into a program called TradeStation called an action candle. And if you look really closely at this chart, you will see one little purple dot on the chart. And that occurred when the stock made an abnormal price gain on abnormal volume. Now, this is one of the top performing stocks of the last 2 weeks. And what you can see is that that purple dot, which signifies abnormal price and abnormal volume activity, started the upward trend. In this case, the stock went from under 20 to over 24, a better than 20% gain in just a few days. And all of that started with abnormal activity. Now, the reason that happens is because stocks that beat the market, that go into market-beating trends, these so-called hot stocks, do so because there is a perception of significant change to the fundamentals. And when there is that significant change to fundamentals, it attracts a crowd. And that creates the abnormal volume and abnormal price activity that starts the upward trend. Now, we can look at it on a very short-term interval, like I have in this chart, which is a 13-minute interval, but you can also apply this thinking to a longer-term chart. Now, here's a chart of ACAD going back weekly a number of years, and you can see that the move that started late in 2012 and has carried us into 2013 also started with those purple dots, the abnormal activity. Now, what's important is to understand that abnormal activity almost always starts abnormal trends, but not all abnormal activity leads to abnormal trends. And so we also have to consider whether the stock was quiet and boring and then erupted with abnormal activity, because that is the best clue that the stock is going to go into a market-beating trend. All right, let's take a look at the charts for this week. Here we have the chart of the S&P 500, and it had a pretty good week last week, despite being a very slow, quiet week because of the holidays. It has broken that short-term downward trend line and is now going to push what I think is the more minor downward trend line. You can see there I've drawn two on the chart. So we should open and finish this week a little bit stronger, but let's make sure that we can get through that upper red line. For now, I am neutral on this market, but I do like how the market is recovering, and I think that we are likely destined to be in a sideways trading range through the summer. The TSX remains a market that is underperforming the US. It has stabilized, it is getting better, but it's fighting with that downward trend line and has not yet been able to break through. And so I don't think it's a particularly bad looking chart, but we just don't see a lot of opportunity in the Canadian market right now, and so you have to be real selective. There's just not that many market beating strong stocks, so-called hot stocks, in the Canadian market. Treasuries really took a dive late last week as the US dollar got very strong because of the concerns in Egypt. Treasuries dropped like a rock, and that is really not great for the stock market because it means that yields went up. Now, I think that we could see a little bit of a reversal of this early this week because the Egypt situation seems to be calming down, but we'll have to remain with our eyes open to see what happens next week. Here's a chart of the emerging markets ETF, and it is trying to reverse its long-term downward trend line, which I've drawn in red. It's not really a long-term trend. I would call that a medium-term trend. It's struggling with that, but it is trying to form a rising bottom. I've drawn a green line on this chart to show the first bottom, and if we can form a rising bottom and then break that red downward trend line, we might see the emerging markets reverse from here. As I said, the US dollar was real strong to close the week, largely because of what was going on in Egypt, and that made a flight to quality the trade of the day. The US dollar is now at resistance where it is very likely to get stuck, and I think we'll see the US dollar back off. That's good for the US stock market. Treasuries should rebound a little bit, and that is also good for the stock market. Gold, despite the problems in Egypt, really hasn't attracted that fear-based money. In other words, the world thinks, okay, maybe there's a little problem in Egypt, but we don't think gold is the hedge for that. And I think that's the new paradigm. Whereas in the past 2 years, people rushed to gold anytime there was a problem, it's now almost that gold has become trivial. And therefore, I don't see a reason to be owning gold these days, as I've said for a number of months. But unless we see a break from a rising bottom or break from through a downward trend line, I want you to stay clear of gold. Oil made a move through resistance, and that looks pretty strong technically. However, it is a move from high volatility, which means there's a greater chance of a pullback, and it's also a move that is motivated by politics. And unless oil's move is motivated by a improving global economy, I'm always a little bit wary of price moves that are the result of political situations because they tend to fizzle out and oil drops back into its trading range. So great to see some strength in oil if you are someone who is interested in oil and gas stocks, but it's a bit of a paper-mache market because these things can quickly change. They're very easily broken, and so don't put a whole lot of confidence in the strength in oil just yet. And as has been happening a number of times over the last couple of years, any strength in the VIX quickly fizzles out. We've seen that happen yet again, and fear is once again not a factor in the market. So I am neutral on US stocks and Canadian stocks. US stocks certainly look better than Canadian, but both of them look to be destined to trade sideways through the summer. I remain bearish on gold, but it is oversold and due for a bounce. And oil, while showing strength, I'm just pretty wary about the motivation for that strength, and therefore I think it's best to be neutral. Stocks continue to stabilize, but it is the US stocks that show the most activity, while the Canadian market remains in the doldrums. Oil is strong for political reasons, which is usually only a short-term catalyst. Be suspicious of this strength. Gold is very oversold, but showing no signs of a trend reversal. Well, that has been the Stockscores Market Minutes for July 5th, 2013. Have a great week in the market and trade well.